All right, so we're looking at the E-mini NASDAQ futures contract for the March delivery. If you remember, I was outlining this imbalance in here, okay? And I gave you the high of this candle, the low of that candle, which it should be sitting right on that. So with this imbalance, we traded down to a discount, back up to a premium. Again, measure the high to the low, and I'll do that for you. All right, so here's 50% as equilibrium inside this dealing range, high and low. So we traded from these lows up into a premium, above 50%, below 50% is a discount. Up here we tried to rally up above this high, failed, broke back down below 50%, and created a gap. Okay, so it comes up back into a premium market above 50% and fills in the gap. I mentioned how this type of retracement can lull traders into likely thinking it's going to go higher, but we're thinking down here. Okay, the liquidity resting below here is what they're going to attack. So all of this consolidation just sets up another selling opportunity to run down there. All right, so it needs to rebalance this first, and it spends 3 days in that range. Then it releases to the downside, attacks the sell side here, and trades into the sell side liquidity resting below here. So let's go into a lower time frame hourly chart and ferret out some more information and details. All right, so here is the hourly chart, and you can see that high end of the fair value gap and the low end of the fair value gap. We traded up into that, sold off, consolidated, sold off once more. So I want to go into what I used, what I saw, and then obviously I'll show you in the account where the details were, okay? All right, so the market started trading, rallied up, took out a short-term high on Friday. See that? Then started to break down. Now, then overnight, I was watching this, but I was hoping that it didn't take out that low before the morning. I wanted to see it trade up here, take that high out, and then consolidate after running below that short-term low. I didn't want it to be in a hurry before the New York session in the morning, because that would have set up a nice short up here where I could have taken a run under this low and then see if I can capture a re-entry, which is the entry you'll actually see me do, and then the drop down in here. Now on Monday it was a bank holiday and trading stops at 1 o'clock in the afternoon on holidays generally. And where we stopped here, we had already moved aggressively lower and stopped right there. So I felt very strongly that we were going to gap down below it, and it gave just a beautiful gap lower and run immediately. But I was looking at the 13,590, 13,586 level real time, and I couldn't get to my screen fast enough to close it out there. And I didn't want to put a limit order in, because if it got really far down below it and started running really lower with a lot of speed and such, I didn't want to limit my profitable exit with having a limit order in. So I just left it open-ended, and I wanted to see how far it would reach down in there. By the time I closed the trade, it closed me at 13,612 and a quarter. So my entry was 13,858 and a quarter. The exit was 13,612 and a quarter. We're going to drop down into a 15-minute time frame. All right, so we had that run on Friday's high here, started the breakdown, and at 10:30 in the morning, 10:33 was the actual fill. So it's right in that candle, right in here. I'm trading in that candle going short. So we're going to go into the details and look at why that was the case. So we're going to go into a 5-minute chart, start going down into the details here. Make this a little bit taller so that way you can appreciate the imbalances that are being shown. All right, so we had this rally up, which in my mind was acting like a Judas swing in the morning. Okay, so here's 8:30, starts to run higher. So I want to be in going short at this candle's opening, and you can see that open, well, maybe you can't see it, the opening price over here. Okay, here is 8:30's candle right there, the opening at 13,798 and a half. So I want to be preferably going short something above that price. Okay, so I'm anticipating further weakness. And before I go any further in this one, I got several people, probably about half a dozen or so, mentioning their confusion with why I mentioned the opening price at New York at midnight and then the opening price at 8:30 in the morning. There's two reference points being specifically dealt with there. If you're looking at the entire daily range, you're going to use the opening price at midnight. But if you're going to be looking at the morning session, you're going to be looking at the 8:30 in the morning opening price. Okay, so hopefully that's made a distinction there. So 8:30 in the morning, that opening price, I'm bearish. I'm thinking we're going to go down below that green level there. That's the old daily low. So on this candle here at 8:30, I'm expecting all this being a fake rally. It's something to lull in traders to chase it going higher. The retracement, people that don't really understand order blocks, they're going to say, look at that, it's a down closed candle. I'm going to buy that. And then when it starts to go up like that, they feel, wow, this is really easy. Every down closed candle after a run up is a bullish order block. It's not. In here is the real context. Okay, we have an imbalance there, and that's what I'm looking at. I'm looking at this imbalance right there. So I'm trying to operate inside that range for a short. Now, I know because of the volatility, it can color outside the lines, and it's okay. The bodies of the candles are kind of supporting the idea of what I'm looking for, but the wicks I could care less about, because I want to get in when it's ideal. And I'm going to show you what that was looking like for me at the time. So we're going to drop down into a 4-minute chart. Okay, so Here is that imbalance and fair value gap on the 5-minute chart, but now it's a little skewed because it takes up 2 candles to show that range. The market trades up, and right in that candle, that one right there, that's where I'm going short. I got in at 1033. Okay, that was my short. Dropping down into a 3-minute chart. Okay, the market trades up, works inside that imbalance, and right there, 1033, that candle, when it's starting to bump up against the top end of that fair value gap, right there, as it hits that and starts to move away, I'm in there. I'm going short right there. The reason why I'm trusting that and not thinking it's going to go higher is because we have this high here, and then we have this high here. Which high's higher? This one or that one? Obviously this one. Now, this candle's high. Watch what happens. From this high, we have a short-term swing high next to it here, and then we have one here. So this one makes a intermediate term high. So we have a long-term intraday on a 3-minute chart, which sounds like an oxymoron, I know, but long-term high, intermediate term high, because this high is lower than that one. But we have a swing high here and here that are lower, both being lower than this one. Then we have the same context right here. We have a high with a lower high on either side of it. So I have market structure behind me showing that this is, number one, it's a bearish market because my draw on liquidity is down here. It hasn't traded down there yet. Okay, so it's going to act like a big magnet. So all these fluctuations in here, without understanding what I'm showing you, it's going to feel like it's just noise. It's chop. It's not. It's actually telling you exactly what it's going to do. So the swing high here is an intermediate term swing high. So I want to be going short real close to this high because it's likely to break like it does here. So at 1033, when it hits the upper end of that fair value gap, I have it now, at this moment, go back one candle. We have this high, a higher high, and a lower high. So we have a high with a lower high on either side of it. That's a swing high. That is lower than this one. That is lower than that one. So it's far more than just, oh, he's just looking at lower lows, lower highs. So what you're doing is you're looking at all the swing highs. And every time you see a swing high, and a swing high is simply a high that has a lower high candle to the left of it and a lower high candle to the right of it. And the one in the middle, that's your swing high. Note that. Okay. In the old days, whenever we saw a swing high or swing low, we would just put a little ring above it, little circle. Okay, like a little halo. And that would be a short-term high. Now, I would do a double circle or double halo for an intermediate term high, and then 3 halos for a long-term swing high. So that way, when I'm looking at price, it allows me to classify the level of high that it is forming. So it's not just lower low, lower high. No, you got to look at the nesting effect of the highs and lows. The candle I'm trying to get in at, and I execute on, with all the understanding of this outline there, I want to see displacement. We get it here. Now, if I didn't take this trade here, I could trade with the return back to this right here. Why is that possible? We have a swing high. It's broken to the upside. This low is taken out here. This candle's high here. If it touches that again, I can be short there, just using the imbalance in the fair value gap entry technique I'm teaching you. So I can go there and get short, or I want to get up here as close as I can to that important high that I've already outlined here. So I want to be in that and wait for that initial move, because then when this occurs, when you're that high up in the session high, so at 8:30 right there, this run up, I'm real close to this high by entering there. Notice that? I'm not waiting for a breakout below that low. So I'm getting up in there where it's an optimal entry. I don't need to get the highest high. You don't need to get the highest high. But you need to understand why it should be trading away from the levels you're trying to enter at. But the displacement comes, which is what I was waiting for, and it gives you a confirmation. When this occurs, it's just almost like, okay, just sit back and just relax and just let it do its thing. Now, Monday, again, was a holiday. So I knew I had abbreviated session hours. So I was going to close at 1 o'clock. So that's right in here. And then the next candle obviously would be 1 o'clock, and it's not trading. So it closed. But it closed here ahead of 1 o'clock, and then the holiday session closing at 1 p.m. in New York local time. And the low, that green level there, remember, go back to the daily chart at the beginning of the video and what we were referring to last week. The liquidity, the sell stops below this green line, that's where it was going to attack. And it came in and did so. It opened up 6 o'clock in New York time, opened up and then slammed down, accelerating lower. That is the move that you want to see, being short up here and covering down below here. Once it does that and it runs into low, deep, that's it. You take your profits and move to the sidelines and then wait, because you have a big gap here. It's likely to come back and rebalance that and fill it in, and it does. And then ultimately trades around that old low and eventually pumps up into the afternoon, consolidates, then goes into the early morning afternoon hours right there. And I showed how this set up, because after a big move, you don't want to trade in the morning session. Just don't do it. So when I have a nice winning day, as you'll see, it was a nice little win. I'm not in a hurry to go back in. And then you have these days here where it can trip you up. You don't know what's going on. You don't know what's likely to occur. So this morning after 9:30, again, what's the bias? bearish. That has not changed. Even though we had this run up, it hasn't changed. So at 9:30, equities open. After consolidation, it runs up, creates a high, and then runs up again, takes out the high. That right there is your run on stops. Wait to see if it wants to break down. It does. So we're going to look at that. But ultimately, right in here, we have a nice little selling opportunity, and you can attack the fair value gap in here between the low and the high. Right there it would be. And if you want to trade with the longer term bias, you could attack the sell side liquidity resting below here and here because they're relative equal lows. And then you would have got a nice fill there as well. So over here, you can see the executions yesterday. I had a scratch where I got in a little too early. I was a little ambitious. And then in the second one, I wasn't sure if it was going to go higher or lower. And just to appease my curiosity, I threw a short in just to see what we'd get. Snapped against me a little bit. Not much, but still enough to get my attention. And I knew what I was looking for. So there's the short I just outlined in the previous portion of this video. Wrote all that down, held for the gap opening after the reopen at 6 o'clock. And there is the close of the trade right there. Nice little dandy. $4,920 fixes the little pinch I took on the one trade earlier in the day. And the one scratch was nothing, it was covering costs.